Let's get oriented. I'm Lazaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, June 1st, 2026. The market enters the first week of June facing a powerful combination of forces: inflation pressure, rising bond yields, labor market data, and ongoing geopolitical uncertainty tied to global energy markets. Investors continue asking an important question: can this rally continue if inflation remains sticky and interest rates stay higher for longer? And now investors must add a fourth variable: whether geopolitical instability begins feeding back into inflation through higher energy prices. Let's begin with last week. Markets finished the week relatively stable as investors digested fresh inflation data, shifting Federal Reserve expectations, and continued developments surrounding Iran and the Strait of Hormuz. The biggest economic report was Thursday's Core PCE inflation release. Core PCE, one of the Federal Reserve's preferred inflation gauges, came in at 3.3% year over year, reinforcing the message that inflation remains above the Fed's long-term target. The report did not create panic, but it did reinforce a growing reality across financial markets. The last mile of inflation remains difficult. Inflation is no longer falling rapidly. It is proving stubborn, and that has important implications for interest rates, borrowing costs, and investor expectations. As a result, bond markets continue adjusting. The 10-year Treasury yield remains elevated around the mid 4% range, while the 30-year Treasury yield recently touched a 5.2%, a level not seen since before the global financial crisis. And that 5.2% level is not just a bond market statistic. Freddie Mac's latest survey places the average 30-year mortgage rate near 6.5%. That directly affects affordability, refinancing decisions, household demand, and household cash flow. The cost of money remains one of the most important stories in today's economy. Meanwhile, the Dow Jones Industrial Average continued holding above the historic 50,000 level and closed near 50,644. The S&P 500 remained near record territory, but perhaps the most encouraging development beneath the surface was improving market breadth. The Russell 2000 gained approximately 2.7% last week, providing further evidence that investors are rotating beyond just the largest technology companies. That matters because healthy bull markets typically require broader participation across sectors and company sizes. Technology remains important, but the AI story itself is evolving. Investors are increasingly looking beyond chip makers and asking where the next layer of opportunity may emerge. That includes networking infrastructure, data centers, energy demand, software platforms, and companies supporting the physical build-out of the AI economy. So what is the market thesis right now? Investors are betting that inflation continues cooling, economic growth remains positive, and the Federal Reserve avoids pushing the economy into recession. The challenge is that all three assumptions will be tested this week. Now let's look ahead. The biggest report arrives Friday with the May non-farm payrolls report, and markets are looking for what economists often call a Goldilocks outcome. Not so strong that inflation fears reaccelerate, but not so weak that recession concerns return. Investors want evidence that the economy is cooling without breaking. We will also receive ISM manufacturing and ISM services reports this week, giving investors another important look at the health of the broader economy. This week also marks Chairman Kevin Warsh's first full week at the helm of the Federal Reserve. While he was sworn in on May 22nd, this is the first week he truly begins shaping the narrative. Investors are watching closely for what some are calling a potential Warsh pivot. That isn't simply a leadership change, it's a potential regime change. Markets want to know whether the Warsh Fed will prioritize greater institutional clarity, inflation discipline, and a more traditional central bank focus on price stability. In plain English, Investors are trying to determine whether this new leadership team will remain restrictive longer than markets had previously expected. Geopolitics also remains front and center. Markets have welcomed signs of diplomatic progress, but today's market environment is a reminder that the situation remains extremely fragile. Over the weekend, renewed military exchanges involving the United States, Iran, and regional actors increased uncertainty and pushed oil prices higher once again. The market is still hoping for stabilization, but it is no longer assuming stabilization. Physical energy flows through the Strait of Hormuz remain severely disrupted. Commercial shipping volumes continue to operate at only a fraction of historical norms, and the market remains highly sensitive to every headline coming out of the region. The market is pricing in stabilization, not normalization. And today's rebound in oil prices shows just how sensitive investors remain to geopolitical developments. In this environment, a single headline can quickly reshape inflation expectations, bond yields, and overall market sentiment. Remember, roughly 20% of global oil trade passes through that narrow waterway. That's why every development continues to matter for inflation, energy costs, transportation expenses, and economic expectations worldwide. So, what does this environment mean to you? If you have a higher risk tolerance, opportunities still exist in areas tied to artificial intelligence, infrastructure, industrials, and sectors benefiting from improving market breadth. But this remains a market that demands selectivity. The easy money phase of the rally may be well behind us. Investors are becoming more focused on earnings quality, cash flow, valuation, and balance sheet strength. If you have a lower risk tolerance, higher interest rates continue creating opportunities that simply did not exist several years ago. Cash management strategies, short duration fixed income, and conservative income producing investments remain worth evaluating within the context of a broader financial plan. At the same time, inflation remains an important consideration. Being overly defensive for too long carries its own risks. The gradual erosion of purchasing power, for one. For everyone else, the message remains the same. The question is not whether markets will be volatile. The question is whether your financial strategy is prepared for volatility, because oil will move, interest rates will move, inflation will move, headlines will move. But your long-term plan should remain anchored to your goals, your time horizon, your risk tolerance, and the legacy you are working to build. Stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.